In the next series of lessons, we're going to talk about gaps. Well, there's a big gap between, a previous day's price and maybe today's price. And what does that mean? And how can we trade these to our real advantage? And there are some definite opportunities with gaps and trading gaps. Some people, that's what they do. They just focus on trading on gaps. So we're going to talk about that in these next coming lessons, and that's going to be very interesting. You might find, like, if you ever traveled like through light rail or something like that, the separation between the platform and the actual train, there's a little gap between that, and you have to step over, and it tells you to mind the gap, right? So it's kind of the same thing with technical trading, that when a gap appears, you have to take a look at that. You have to be cognizant of it, because something significant could be coming on. So whether you're taking the train or technical trading, either way, it's very important to mind the gap. So let's talk about, well, what do we mean by gaps and when there's a gap or not a gap? So how do we use gaps to our advantage? And because they can be a really terrific trading opportunity for sure. And the key is to differentiate between what is a common gap and an uncommon gap. So let's look at those here very briefly. A common gap is something that can occur in a trending or non-trending prices. So it can occur in either one. And a common gap doesn't change the trend or start a new trend. It's common, nothing's really going on. There's a gap, yes, but it's not going to make a big difference. It's not going to change the trend or start a new trend. Those are the things we're really watching for. It's simply noise, nothing's going on. It might be a little flutter up or something like that because of some announcement or a rumor or something happens. And a lot of times when you see these common gaps that are not impactful, it occurs when the trading volume is low, right? There's less people trading, so there's not a lot going on. So a good way you kind of verify if something might be a common or uncommon gap is look at those volume levels. If the volume levels are low, very good chance it's a common gap versus something that an uncommon gap we're going to talk about next, where it's very significant. A common gap would be something that's not significant. So if that volume is high and there's a gap, then you might have something that's real significant, which is the uncommon gap. And that could lead to a big price rise or fall in the next coming time periods, like days, in the next coming days. So an uncommon gap is a significant event that is occurring that may impact the pricing trend and provide a great trading opportunity. So we're really looking for is uncommon gaps. And there's 4 key ones to really look at. And those are breakaway gaps, runaway gaps, exhaustion gaps, and island reversals. So the next lessons, we're going to go through each of those individually and show you how to watch for them, how to recognize them, and then how to trade on them, to make some profits off of these types of gaps that can occur. Now, gaps are actually, rare things. That's why they make a great trading opportunity, because, something unusual has happened. There's been some significant event or significant news, and it's caused a gap in the prices. And a good way to identify it is first understand what it typically there is, and that is there's no gaps. When you look at, let's say, this chart like this, you'll see, our opens and our highs and all that, but really we're looking at the trading range of the highs and the lows. And you can see from the trading ranges, whether it's an up day or a down day, there's always an overlap from the day before. Even where we have that big spike on the right-hand side, it opened much higher. There was actually a gap at the opening where that left tick mark is on that really spiky red bar. But then the prices came down to kind of overlap again from the previous day. And then it goes on, so on from there. So there is some type of overlap when there's no gaps, and that's actually very common. What we're looking for is a situation where those ranges don't overlap at all. That would be a gap situation. So if we look at this example here, you can see like days 1, 2, 3, and 4. And this could be whatever time periods you want. If you're trading on minutes or hours or however your trading time frame is, we'll just use days here to keep it simple. But in particular, you're really looking at those closing, open and close prices. That's really more of the classic formation of a gap, is looking at an overall days trading range. And so days 1, 2, 3, and 4, you can see there's overlap between each of the ranges of bars. I don't have the open and close on here because that's not important when you're looking at a gap. You're looking at the range from the high to the low. And there's overlap from days 1 through 4. But then on day 5, there is a gap. You can see that there's a space in between the highest high of the range from day 4 does not even, there's a gap between the lowest low on day 5, so there's no overlap between them. And that would be a gap situation. Now, you can identify a gap at the start of a day because by nature, for a gap to occur, the opening is going to have to occur somewhere in a void, somewhere above the trading range of the day before. So you can say, oh, this is something's going on here by the opening. You need a gap at the opening for sure. But you cannot measure a gap until the day is over, because it could open as a gap, but then let's say in this example here, the prices actually fell and that bar got longer on day 5 going downward where there was overlap. If there's any overlap at all, there is no gap. There has to be a gap in terms of no overlap. That's the key thing to take away. So that's why you can't tell until the end of the day whether there's a gap situation that occurs, and then we're going to need to wait a little bit longer, as you'll see coming up, to confirm that gap, and that is a trading opportunity. But for now, no overlap. It can open, it can open in a gap situation, has to close in a gap situation, and we're really looking at the highs to the lows. And so you're measuring from yesterday's high to today's low. It would be an example of an upside gap. There's a space between yesterday's high and today's low, or from yesterday's low to today's high, where there would be a downside gap. So gaps can be either going upward or going downward. And the difference is between, again, the bar's highs and lows, not the opens and closes. So just really when you're looking at the gaps, you're really looking at that trading range of highs and lows. So if you're going to look at this example here on the right, what would you think that is? Is that an upside gap, or would that be a downside gap? Kind of looks at it like you're going upward, so if you guessed that, you're right. But yeah, yesterday's high, it does not match up to, or does not overlap today's low. So there's a gap in between the two. By the same token, if we looked at this image, you'd see a downside gap where yesterday's low does not overlap today's high. There's a space in between them. And so there's either a downside gap or an upside gap. Gaps can be either way, either up or down. And what you have going on here is you have a void. You have this space, and what's going on is there's no match of buyers and sellers. There's no matching of somebody looking to sell or buy at a certain price range within that gap area. There's a gap between the two price ranges between the 2 days. In this example here, prices had to go upward to form a match. So there might have been people trying to sell just a little bit above, the day before, or maybe even below, or right somewhere within the range of the day before. But something happened, either some good news or something that triggered where everybody's saying, no, I'm not going to sell that low. You're going to have to pay more for me to sell. And so the prices rise, and you can see a gap there between the 2 days. So there might have been some really good news overnight that had caused the price to jump up and create the gap. That's what's happening. Like in this example, could be the opposite in a downside gap. In this upward gap, you can see there's some news overnight. Prices jump right up, right even before the opening, and the first opening, bid, or so to speak, or trade is well above the overlap range. There's a gap in between. So that's how you kind of understand gaps, and what you're looking for is you're basically looking for the space and this void between two trading periods, or between the 2 days. Okay, breakaway gaps, very, very, very important. And what happens when there's a breakaway gap is it's going to bring in a lot of new traders, and add volume. That's one way you can tell if it's an uncommon or important type gap. You're going to see volume rise. It's going to bring in new traders, and it's usually driven off some type of big event or some news thing, something that's happening that's really driving the impact on that security and really impacting. And there's a gap. It could be up or down, but there's a big gap that's coming. And it frequently marks the start of a new trend. When you have a breakaway gap, and I'll show you this visually what those look like in a moment here, but when you have that, it can mark the start of a new trend. There's a major change coming. There's a major change in your chart that you'll see. You might see that the daily trading range, the high-low starts to widen. You might see an increase in in-day volatility with lots of things being sold high and low all throughout the day. And also, we mentioned the much higher trading volume are good indicators that a breakaway gap is occurring. And what happens is it's actually going to break through support and resistance levels can help confirm a significant breakaway gap. So, support level would be like low prices and resistance would be high prices, and somehow it's breaking through something, breaking through some, this trading range of prices, and that's why we call it a breakaway gap. And it is a significant leap in terms of the price, and we'll take a look at that now and how to trade on that here visually. So in this example, we have an upward gap, right? We have a gap between days 4 and days 5 prices. And what you're really looking for is a couple things. Ideally for a breakaway gap, you want it to be really proportionally big in terms of the trading range. So for example, if the normal range is, let's say, $3 or whatever your currency is, and the gap is $15 as far as between the preceding day's high and low, and the gap day then opens up higher than that might show you that something significant is going on. There's a big gap in between the prices, and the more significant the gap, the more impactful that is, and the more likely you might have a true breakaway gap. Again, we have to wait till the end of the day to really confirm that it's a gap, that it doesn't come down in price like in this example and just overlap, and then we don't have a gap at all. Well, if we look at this, we have this proportionally big in terms of the trading range. There's a big jump up in terms of what was going on before, between days 4 and 5, and you can see in the preceding days kind of confirm that as well. And then also, to really identify a breakaway gap, it occurs when price is only slightly trending or moving sideways. There's not much going on, and then boom, it happens. It's not like there's some big, massive trend, and you have a little breakaway gap, but it's already part of a massive trend. That's not a true breakaway gap. That's something else actually we're going to learn that's going on. But if you look at, like here in this example, you can see where prices are day 1, they're in 2, 3, and 4, they're up, they're down, there's no significant trend, or it's kind of moving sideways, and then there's a big leap up. If anything, you might have said, well, between days 2 and 4, there might have been a little bit of a downtrend, and then all of a sudden, boom, there's a big gap upwards. To day 5, something had caused that. So when you're looking at an interpretation of these, let's look at this one here. This is an example of an upside gap, as we know. So if there's something happens, some good news, creates demand, and people want the stock badly, or the security badly, and they're willing to pay higher prices to get it. Volume noticeably is typically noticeably higher than usual. If we were to put volume along the bottom of this, and we look at some other charts later, you'll see that. But if we had volume here, you'd usually see a spike or a dramatic increase in volume, because there's some news overnight, some good news, everybody's like, oh, this looks like a good security, I want to get in here, and a lot of people are getting in now, and they're willing to pay these higher prices right from the start of the day, and that's what helped create this big upside gap. The other way of looking at a breakaway gap, of course, is a downside gap. And what that means is that current security holders, they want to get out of it. They want to dump this security and sell it, and they're even willing to accept even lower prices to do that. They're willing to go even lower than whatever was the low of the range the previous day. They just want out. And volume, again, is usually, but not always, but usually abnormally high in this case as well. Again, there's some kind of event, something's happening, and there's a mass movement either up or down. In this case, this would be a downside breakaway gap where there's been a significant kind of move here to sell the security. So either way, you're looking for these gaps, and you're looking for these significant moves for a breakaway gap, as opposed to other gaps we're going to learn about. Another gap, of course, that's really important is a runaway gap. And they're very, very important because it relates to continuing to ride a trend and continuing to ride that trend that might be happening when you have this runaway gap. And if you think about it, what the difference is between a breakaway and a runaway gap is a breakaway gap is the breaking away. It's breaking away and it's starting a trend. A runaway gap is one where it's continuing the trend. So you might have a breakaway gap that changes things and starts a new trend, and the runaway reinforces that later, as prices go, reinforces that and continues that trend. And maybe you want to continue to add to that position and continue to ride that trend if it's, let's say, an upward trend. It could be upward or downward either way as far as a runaway gap. But the idea is it's not creating a new trend, it's continuing an existing trend as a runaway gap. And that means there might be some even more good news coming out or something that's been building on this, and there's a fear of missing out or FOMO or whatever, so it's created a big leap, let's say, in pricing. And so let's take a look at runaway gaps and how to recognize them, and we'll talk about the trading opportunity with them.
So if we keep looking at our example here, you can see how over this time period there was a breakaway gap, and then that started a new trend, right? As breakaway gaps will start a trend, and this happens to be an uptrend. Then there's a little sideways movement, and then we have a gap between days 11 and 12, and that would be a runaway gap. Again, it's you can see it's kind of continuing more of that previous trend. So that's why it wouldn't necessarily be a true breakaway gap. It's real continuing the trend, and that's what makes it a runaway gap, a real strong indicator as far as that continuation of that trend. If we were to look at it in a different way here, you can see the black line shows that trend from the previous breakaway gap from starting on day 5. And then we have a little bit of a pullback, which is normal. People will buy in a dip. We had a little trend, of 3 days. People will sell a little bit, and then new buyers will, so that goes down. And then new buyers will come back in and reinforce the trend. And so we have that buying on the dip when it kind of dips down for a pullback for a day or two, maybe even 3 or 4. And then we have back again more of a movement back towards an uptrend. In this case, it could be a downtrend as well. But in this case, we're looking at uptrends. So we then have that big gap between days 11 and 12, and that's the runaway gap. So you're really reinforcing the continuation of the trend. It is very normal and natural to have a little bit of a pullback, so you want to be watching for that. And then all of a sudden, if you see another gap come up, that's your runaway gap, and that's going to really reinforce the trend. It's going to continue the trend. So we'd be looking forward to days 13 and going forward that trend that we had seen before will keep going, and that's a really good buy sign. If it was the opposite way, that'd be a good sell sign on a downward trend. But in this case, the example we're using, we can see we've had our breakaway gap, we've had a little bit of a pullback, now we've had a runaway gap, and we're still going, and we're still doing well, continuing with this trend and getting some profits there.
Oh, look at this kitty here. He's so tired. He's so exhausted. And that's what we're going to talk about is exhaustion gaps when they start to run out of steam. So what is an exhaustion gap? Well, it's all part of these uncommon gaps that we've been talking about, but the exhaustion gaps occur at the end of a trend. And really what they're signaling is things are going to start changing, or the party's over. It's starting to end. We're getting exhausted. So what's being exhausted is the news or whatever's happened to propel the energy of the early buyers that drove the security up in the first place. Let's say if it's a upward exhaustion gap, right? So you might have had a breakout gap that changed it and made it go up, let's say as a breakout. You might have had a runaway gap that continued that trend, keeping it going forward. But at some point it runs out of steam and has maybe another gap in prices where you see what's called an exhaustion gap. It's kind of like that one last buyer after a buying frenzy is over. There's like one last person and then it starts to kind of go the other way. That's what an exhaustion gap is. So let's look at an exhaustion gap in relation to what we've been looking at in the other types of gaps.
So if we continue with this chart pattern here, you see we talked about our breakaway gap and we talked about our runaway gap, and that created the breakaway gap created the trend, and the runaway gap continued that trend. But then the trend started to run out of steam, and we have an exhaustion gap here. We have that kind of last buyer or buyers jumping up, creating a new gap, saying, this is so exciting. The trend's great. Let's drive these prices even higher. And you see where, they start to kind of run out of steam there. And you start having what would become an exhaustion gap, where you have that gap, and then like day 16, we're going to start having overlap, and we're going to start seeing that coming back down, is what would happen in an exhaustion gap. One way you can tell with that too, what's the difference? How do we know it's an exhaustion gap versus a runaway gap, or how to be aware of that? Because maybe that exhaustion gap is just another runaway gap. What we're going to look at is you're going to have low volume on an exhaustion gap, and you're going to have high trading volume on a runaway gap. So you think about your volume, how many people are actually trading things. If we look at the bottom of this here, you can see on day 12, where we had that real high spike in volume. That means a lot of people wanted to get in on the security on day 12 there, and they drove that price up, and then it kind of continues from there. Where if you see a gap like this, what's going to become an exhaustion gap, you're going to see where the volume starts, you have your gap, but then you see that the volume is actually pretty low. Again, that's an indicator that there's, in this example, less buyers out there. There's a couple, maybe the last one, who's willing to pay these premium prices, but it's starting to really run out of steam. It's becoming exhausted. So that means the party's over, so to speak, right? And so you're now going to have some overlap. You're now going to have maybe the security start trading sideways, or maybe even start to reverse and start going on a downtrend. So when you're trying to decide, am I looking at potentially a runaway gap or an exhaustion gap, look at that volume there and what's been going, typically with the volume on that particular security, leading up to this. And if you see a spike in volume, then it's a gap. In this case, could be a runaway gap. Or in any security, you'd have a high volume with a breakaway gap you'd look for. But an exhaustion gap can be real telling when there's already been an very established trend, and the trend is ending, and that's because you're seeing some low volume there. So be watching that volume there when you're trying to decide, am I seeing a runaway gap or exhaustion gap? And being ready to make a change, either way, whether, looking at where that trend is going to then change your head and get out, if it's appropriate, if it's an exhaustion gap.
So if we look at this island here, you might say, well, that's a nice looking island. It has a nice beach. It'd be a nice place for me to relax on. But what if I told you there was nobody there with you, and there was no food or water, and nobody was coming to help you? It might not be such a great place to be, right? And that's what island reversals are. A lot of times they're not a great place to be, but they can be a very strong indicator to show what's going to happen next. So they're rare, they rarely occur, but when they do, they're a very, very strong indicator and could provide a great opportunity. So if you see an island reversal, you really want to pay attention to it. And kind of what they are is it's an exhaustion gap, where it's been exhausted, as we learned about, and it's going to have this gap, followed immediately by a breakaway gap in the opposite direction the next day. So what you're finding is that whichever way it's going, that breakaway gap the next day, you're finding a last trader who kind of finds they're on an island, by themselves, and they have to start adjusting their price either up or down to kind of get back in step with people who are willing to buy and sell or trade with them, and are basically looking at maybe a different way the trend is going to go. So let's take a look at these island reversals and how to recognize them in a more understandable graphic manner.
So to identify these island reversals, you're going to need an exhaustion gap, right? And so we know from day 14 to day 15 that we're looking at an exhaustion gap. We saw that our volume was not going up. It should have had a real spike in volume there. It actually went down in terms of our volume between day 14 and 15. And so we know we're running out of steam, and that is our exhaustion gap. And then what typically will happen is you'll now start seeing overlapping bars, and it might start going sideways, might even start going down, or basically the trend has been basically broken at this point, and it's not trending upward anymore, as in this example. But sometimes what happens is the island reversal, as we mentioned, you have an exhaustion gap that is immediately followed. It's immediately followed by a big jump up in price, that looks like it's another runaway gap. The classic way to define that, it would be the next day, as far as there being a true island reversal. Sometimes folks will say, oh, you might have one or two trading periods in between, but really the classic way to look at it is between, like in this example, 15 and 16, you're going to have these two kind of back-to-back gaps. So you have your exhaustion gap, low volume, and then all of a sudden it just keeps going up higher. There's a whole nother big gap, let's try to push this even higher. And that's where you might see, even lower volume, let's say coming on, that bar in between those volume bars, where you could see even lower volume because it really is truly exhausted. You're really on an island. You're the last person out there trying to buy, and you might have a couple sellers out there, but it's really already post the exhaustion phase. And really where you can tell is you can start looking for that low volume on that exhaustion gap, right? So there's low volume, and that tells you it's time to sell. There's high volume on a runaway gap, that tells you to buy, right? We saw a previous, on day 12, that runaway gap where it's time to buy. But a low volume island reversal is you're going to have that low volume on the day 16 in this example. And then the time to sell or buy depends on the island, right? You're waiting for the island to form. So we don't really truly know at day 16. We need a day 17 to show what's going to happen. And then what will happen is then on day 17, there's going to be some high volume is one way you can see you got your island reversal. You've got these low volume days of exhaustion gaps, and the island forming, and then the reversal going the opposite way is happening where there's a lot of volume and it's going to go the other way. So the time to sell or buy depends on the island, as I mentioned. So if we look on the left here, you can see that this was an upward trend that was exhausted, then jumped up from day 15 to 16 to an island. And then we're waiting to see what happens on day 17, and that's really what's going to confirm that we're on an island, that it didn't continue going up or something like that, where it might have actually been more of a runaway gap. It was actually a true island, after an exhaustion. And you can see how now prices have come down and there's another gap in between, but a lot of volume. Now people are really selling and they're trying to get out of it. That's the example on the left side. So that's now created a new downward trend on an island reversal. So it's time to sell, get out, book the profits that we've made from day 1 through 16, if we're staying the whole time, or 14, or however we've stayed along. But if we're in this security right now, we'd want to get out, right? By the same token, if you look on the other side, where if you look at day 13, 14, 15, things have been downtrending, right? We haven't bought yet because it's in a downtrend. There's an exhaustion gap from a previous, runaway gaps and breakaway gaps that have led to a strong trend going downward. Prices are going down. We see the exhaustion gap between day 14 and 15. We see day 16 following that exhaustion gap going out by itself on an island. We're going to watch to see what happens on day 17. What happens at day 17? The price goes back up significantly. We see that high volume. We see that we have an island reversal, but actually it's going in the other direction, and we want to buy on that. Now we're seeing a new upward trend that is forming, and so this would be a great buy signal, kind of confirming with that volume that we have an island reversal going in the other direction. So the key points is you don't know if it's an island until the second gap occurs. It's day 17 in this example. You might see it jump out way ahead after an exhaustion gap and kind of guess like, oh, is that a reversal? And it could be, but you really need to look at that volume, and you really need to confirm with that the following day. Others will guess based on the volume. Like if it's a low volume, they might say, oh, on day 16 our volume was low. And then we're going to guess and say that's an island reversal. And that's not a bad guess, actually, but to be a true island reversal, you're going to need that day 17 in this example. See, there's high volume there that really establish that, yes, things have changed. There's a definite change, and now a new trend is forming. So to really look at a classic completed island, you'll have to have an exhaustion gap with low volume, followed by an island gap with low volume, and in a sense, a breakaway gap, high volume, going in the opposite direction, forming that island. And you don't want to be on the island. You want to get either off the island or get on the new trend, depending which way it's headed. So those are island reversals. They're actually very rare occurrences, but if you see it and you kind of recognize it in a chart pattern, really watch that closely, because they are very, very strong indicators, probably because they are so rare and there's so many requirements behind it, right? With the exhaustion gap, all that coming in, the strong trends coming beforehand, either up or down. So watch for island reversals and be ready to strike. Nothing's perfect, of course, but this is a good, strong indicator. And do check those volume levels to kind of confirm what you're seeing is what's truly happening.